So welcome everyone. Thanks very much for joining us today. We're starting to run a few also specific topics, especially around the property, investment properties, and so those types of areas. So today I'm going to talk about tax and rental properties, what you can and can't claim, plus a bit of strategic tax planning around that. So after this session, we will send out a recording and also the slides as well. So I think most of you who have joined us today, I think there's only a few unfamiliar names, but most of you have probably met myself, Shannon Smits. I'm the founder and managing director of Smart Business Solutions. I'm joined today by Erin Turner, who's an intermediate accountant. She's been with us 4 years and works on a lot of my projects, especially in the property side. Many of those of you who know me, I actually really love property, whether it be a development, whether it be an investment, or anything in a combination of that, or even looking at super. So it is one of those topics that we do have a lot of clients in this space, but we also really enjoy talking about it. So today I'm going to go through a few of the topics. I will get Erin to take over and go through a few of the topics as well. And if you've got any questions, feel free to add the questions into the question area. We'll get through to those during the end, and if there are any other topics. So what I want to go through today, and I've just picked out some of the key areas rather than going through 101, what are rental property deductions, and I always have the analogy that would I have incurred this expense if it wasn't for my work or my business, or in this case the investment property, and looking at that. So I'm really picking out some key areas that we tend to see misunderstandings from a client perspective. That can be due to maybe the barbecue accountant that tells them at the barbecue what they can and can't claim for tax deductions. It can also be due to the real estate agents sometimes telling them, and there have been a few changes now. So there have been some changes on some of these areas over the past few years, which I think that not everyone's as familiar with. So we've really just picked out some of the key areas that I'd say there are a lot of misunderstandings, or people tend to get that wrong. One that is coming up a lot is this genuinely available for rent. And what does that mean? So especially the ATO is focusing a lot on properties located in popular holiday destinations. So those of you that maybe have that holiday house on the Mornington Peninsula, a lot of us get to live down here, or maybe you've got that holiday house in Phillip Island. The ATO has been actually sending a lot of please explain letters to those that have claimed the rental property in their tax returns. It may be negative geared because they've got a borrowing against it, and it may not be have had much rent during the year. Now, this I think is going to increase and be a bigger focus of the ATO. The reason I say that, a lot of people, what we saw during especially the COVID lockdown, a lot of people did move down into their holiday homes. There is a shortage of homes, and I'm seeing that on the peninsula, that even to buy is almost nearly impossible, and even to rent, there's hardly any rental stock available. So for someone to lodge their tax return, and let's just say 30th of June this year, and actually say that their property located in Rosebud was empty for most of the year, but it was actively available, I think you're going to have a challenge potentially from the ATO. And there's a lot of risk features around the property area that kind of feed in the different filters that we have to, and boxes we have to fill out on the tax returns, that feed through into the ATO's risk engine. So that's really a high one, a focus for the ATO at the moment. So what do we mean when we're talking about actively available for rent? There must be, you must be like active bona fide attempts made to let the property out at a commercial rent. So there must be advertising. It's not just a case of, and we've seen this before, putting it on Airbnb for, $3,000 a night, and, it's really only getting $200 and saying it was actively available for rent. It needs to have it, and looking at the location and condition means that it's unlikely, if tenants weren't going to seek to rent it out because of the specific situation, if there were unreasonable or stringent conditions on it. So yes, we've got it available for rent, but these are all the requirements. And refusing rent to interested parties without adequate reason. So you really need to be able to prove, and I guess from a client's perspective, if someone has got a property available for rent and they don't have tenants in it, it needs to be really, I would say the easiest way is that it is listed with an agent. But if you are using a property as a holiday house, but you are renting it out for part of the time, and we're not not covering that today, and that's something we have talked about in the past, and we do have some blogs on that, but it is something that you do really need to look at, pro-ratering of the expenses based on the time actively available for rent, general, and when you specifically then used it yourself for personal purposes. I'd probably say it's just really not worth the risk at this point with the way in which the risk engine is working and the penalties and interest that we're seeing that are coming through as a result of that. We've even seen the ATO look at people's Facebook accounts and see when the people have put on Facebook that they've been at their holiday house and matching that through. So the ATO are getting quite creative in the way in which they're wanting to go through and address this. Have you got the property generally available for rent? So next we're going to go on to repairs, and I'm going to pass you on to Erin to go through repairs. This is one that we often see a lot of misunderstandings on as well.
Thanks, Shannon. So yeah, going through repairs. So this, again, is another huge area that the ATO has expressed a lot of concerns around. So we're looking at repairs and maintenance. And if you own a rental property, as you probably know, repairs can be quite significant. So it's even more important than ever to make sure that you're applying the rules correctly, because if you do claim a huge chunk for repairs, that may raise a flag to the ATO. They may ask some questions. So before we get into any specific examples, let's just kind of take a step back and look in broad terms, the criteria you need to be able to claim these repair deductions. So you can see on the screen here, we've got 4 dot points. So these are the 4 criteria that you need to meet to be able to claim that deduction. So if we go through the first one, we have, so if the work restores the property or asset rather than improving it. So a good example here is, say, if your property was damaged, you just need to merely show that you're just restoring it back to its original state. You're not improving it. If you go beyond that, so you repair it and make improvements, well, is it really a repair? So that's kind of where the ATO starts to question it. So the first criteria is that you have to just be restoring it back to its original state. The second criteria we have is no assets are being replaced in their entirety. So for example here, to put an example on it, you have a tenant, they've just advised you that the dishwasher has broken. If you can have someone go out and repair it, that's great, that's a repair. But say, unfortunately, you actually need to replace that whole dishwasher in its entirety, well, that's no longer considered a repair, and it's actually a capital expense and will most likely be depreciated across a number of years. With depreciation, we will go into that in more detail later on, but that's the example around repairing, so as long as it's not being replaced in its entirety. The third criteria we have, so that's if the costs incurred while the property is used to produce income in the same year. So the ATO does have some flexibility around this, but generally speaking, they're just making sure that any expenses incurred are only being claimed in that same year that the income was produced on that property. So quite a straightforward one there. And we do have an example coming up. And then the final criteria that you must meet in order to claim a repair deduction is that it's not an initial repair. So basically the ATO says here, if you're fixing a problem in the property that was there when you first purchased it, well, it's not actually a repair. They consider that a deduction for your cost base of the property. So you can't actually claim any costs associated with fixing the house up when you first purchase it. It just forms part of your cost base. So you can't claim an immediate deduction in that financial year. What often comes up is actually when the council, say, advises you that you have to, make this repair or do this in the property to become maybe compliant, or for whatever the reason. Even if you've owned the property for more than 20 years, if that problem was there when you purchased it, you can't claim an immediate deduction for those repairs. And then we move on to more the practical issues. So if we take a look at the practical issues that come up quite often. So we've got the first scenario here is, say you're living in a house, you now decide you want to move out, but you still want to hold on to that property. So you decide to rent it out. Most people in this scenario will make a few changes to the property to make it more suitable to be rented out. So the most common example would be, refreshing the house with a fresh coat of paint. In most cases, you won't actually be able to claim a deduction for this. There is an exception. So moving on to the second point we have here is, say that if the property was actually up for genuinely if it was advertising for rent. So what Shannon's just gone through, is it genuinely available for rent? If you had an advertisement up, the property hadn't been tenanted yet, but it was genuinely available for rent, and say, a good example is, say there was a big thunderstorm, hailstorm, and there was damages made to the house. Because it was genuinely available for rent, you would most likely be able to claim a deduction for any repairs that you made to fix that property back up. But you do have to remember not to follow those 4 criteria that we just went through to ensure that it's actually repair and maintenance. It's not a new asset, or you're not going to be capitalising from a capital expense. The third practical issue we have here is if it's a separate asset or part of an asset. So it can be more difficult when you make substantial repairs. If we take the same example that I just went through with, say, the hailstorm, say in this case we had a tree fall on top of the property, so obviously huge damages to the roof. It might make more sense to replace the whole roof rather than repairing it. So in this case, the ATO might actually say, well, it's still a genuine repair, but remember, you don't want to be seen to improve in the property. So it can be a bit of a grey area there. So I do advise, if this has happened, to obviously speak to your accountant beforehand, because you don't want to be claiming an immediate deduction for repair and have the ATO question it at a later date. So now we're going to move on to an example. So just the next slide, Shannon. Awesome. So let's run through an example here. So let's say this property has been used as a rental property for a number of years, and the tenants have just moved out. So some damage was found by the landlord after they were moved out back in April 2019. The damage was then fixed in June 2019, so the property could then be sold. So the question here is, can we claim that as a deduction? So here we're actually looking at a timing issue. So remember, going back to those 4 criteria points. So we're looking at those 4 criteria points, and we're just making sure that the repair made and when we've paid it was in fact in the same year that we incurred the income. So in this scenario, it looks like it most likely will be deductible because we earned income in April of 2019 and we then paid for the repairs in that same financial year. But say if we received the invoice and the repairs were made in July 2019, well, that can make it a bit more difficult, and the ATO would most likely say that it's not a repair to claim immediate deduction, but it would still form part of the cost base. So do keep a record of all these expenses, because you would need that when you do sell the property later on. Moving on to now body corporate levies. So this area it can be quite complicated. So if you say are in apartments or a block of units, you most likely pay a body corporate fee every year. So this fee usually covers the general maintenance and repairs around the facilities. So those obviously are a deduction, but looking at body corporate levies, this is usually an extra cost charged to you as the landlord. So in most instances, the ATO actually assumes that these levies that you pay are always going to be capital of nature. So you can't claim a full immediate write-off. But again, you do always have to look at these expenses in detail, because there may be some cases where it's not an improvement or not a capital asset, it is genuine repairs. So a common example, for instance, if you pay $500 a year for body corporate, they've gone through and made all their repairs and maintenance, but they've realised they've actually underquoted everyone. So they might say charge you an extra $200. That would still be deductible straight away, because they're not improving it. They're just basically increasing that body corporate fee. So that's a common example that we do have. One area to also be concerned of is, for example, going back to if you own a unit in a block of units, if the body corporate levy is charged out to you and you've recently purchased the property, you have to still make sure that you meet those 4 criteria points we went through. So making sure that it's still not an initial repair and still making sure that you meet the other 3 as well. But again, this one doesn't come up too often, but if it does, it's worth asking the question whether it's obviously a repair or capital, because you want to be able to write off that expense right away in the same year. Okay, so that's it with repairs. Moving on to interest expenses. So here we have the fundamentals. So when you obviously have an interest expense, it's usually because you've borrowed some funds. So the most common ones obviously being, you've taken out a mortgage for the property that you've bought. So it's always a question of, is this interest deductible? So the starting point is obviously looking at how that money that you borrowed was spent. So if you've claimed, taken out a mortgage of $300,000, but that all went to the rental property, then you're usually going to be able to claim 100% of the interest on that mortgage. But on the other hand, if there's some portion of that maybe have gone to private expenses, well, then there would be prorating of the interest. So that means basically you're only able to claim interest for the portion that it's related to the rental property, and then there'll be some interest that's not actually deductible. So if you refinance a loan, this also doesn't usually affect anything either, as long as, going back to those terms, that the property is 100%, the loan is for the property at 100%, for instance. You do have a couple of types of ways to get money out of a loan. So most of you that have a home loan would be familiar with redraw and offset accounts. If you decide, say you don't have a rental property at the moment, but you're, say, looking at buying one, or maybe looking at buying your second rental property. Say you have a private home loan at the moment for your personal home, and you've got a bit of cash sitting around there. So you've got two features of a loan. You might have a redraw account, or you might have an offset account. So the way the ATO kind of draws the line, that a redraw, so if you take money out of your redraw, that's considered a new loan. So in that scenario, we'll be able to claim some of the interest that's paid because that redraw amount's going towards the rental property. Now, if you have an offset account, say you have a nice chunk of money in there, say it's $100,000 or $200,000, and you take that money out to use that to put a deposit down or pay off some of the investment property. Because it's an offset account, the ATO says this is considered savings and you won't be able to deduct any of the interest on that loan. So even though it might increase, we all know an offset account should decrease the interest you pay. Once you take that money out, your interest expenses will increase, but they say you're actually not going to be able to deduct the difference in that because the offset account is considered savings. So if you're looking at buying a rental property, it is worth making sure that you know that terminology, and just making sure that you know if you're going to take money out of the home loan that you do have at the moment, just making sure that you kind of look at those areas and understand that you won't be able to claim interest off the offset, but you might be able to off the redraw. So that moves into the mixed use loans. So if you kind of have a private home loan, obviously interest is not deductible on your private home loan, but if that loan then turns into a part of the loan for the investment property, then there would be obviously a portion of that we can claim as a deduction. So if we move into a practical example, so we have Betty here. So she has a $400,000 home loan. There's an offset account, and she has $300,000 sitting in that offset account. Betty wants to buy a rental property and plans to use $200,000 of that offset account, which will obviously then increase the interest on the home loan. Can she deduct the increased interest expenses, and could this be done differently? Well, to short answer to the first question, no. So like I said before, the interest, because she's used the offset account, even though she now has to pay more interest, the ATO says no, you can't claim any interest if you use offset money. Could this be done differently? Well, yes. So she could potentially, pay that $200,000 off the home loan and then maybe redraw it, because then if she uses the redraw facility, she then can claim a portion of the interest. But it's important here not to just make those changes without advice or looking at that structure, because you would hate to pay that large chunk of money off your loan and then realise you can't get it back out. So this could be done differently, but no, she wouldn't be able to claim the increased interest expense in that scenario. Here we have a second example. So we have, this one's more focused on a mixed purpose loan. So we have Zara, she's borrowed $100,000 from the bank. $50,000 was to purchase a nice new vehicle, so that's used privately, and then she has $50,000 which was then used to finance improvements on her rental property. Zara makes a repayment of $10,000. Question here, what impact does this have on interest deductions? So this example is nice and easy because it's split down the middle, it's 50-50, 50 used for private, 50 used for the investment property. So it makes it a bit easier to look at what interest is deductible. The ATO says when a payment is used against the loan, you can't choose what portion of the loan it's paid off with. So you can't say, I'm going to pay the $10,000 off the portion I used to buy the private item, so the car. As nice as that would be to be able to lower the interest on the car and have the full interest claimable on the rental property, you can't do that because it's the one loan. So in this case, it would have to be prorated. So this just means that we'd only be able to claim a deduction for the investment property portion. So the next interest expense that comes out, Zara will just be able to claim the 50% of that for the rental property.
Yeah. And it's interesting in this space on what the ATO is focusing on, because this was, to be quite honest, common practice for a number of years, but I would say the last probably 3 to 4 years, the ATO has been denying a lot of deductions when you've got this mixed use loan that Erin's just gone through. This exact example is what we see time and time again. So the recommendation that we're saying to clients is to go and get that new loan, unfortunately, because if it is for a mixed use, we're just getting straight denial from the ATO on any deduction. You can't just assign on how that's allocated. So that's where it does come down to having that separate loan, makes it a bit easier in the long run.
Definitely. Thanks, Shannon. And I guess to finish off with the interest deductions, just a few other important areas to note. I won't go into these ones in too much detail because it can be quite specific to your own scenario. But if we go to the first point here where it says expenses incurred before income is generated. So as long as all the criteria is met, you may be able to claim a deduction for interest incurred, but there has been some significant changes since 1 July 2019, especially around vacant land. So we don't go into too much detail because it's kind of a whole new topic. But if this does sound like you have vacant land and want to know about interest deductions or anything like that, please feel free to reach out to us or your accountant, because again, it can be very specific to your situation. And then we have our second point here where expenses incurred after income producing activities. So say you sold your property at a loss and you couldn't actually afford to pay off the mortgage you had against the investment property. The ATO is quite lenient in this sense. If you meet the criteria, they will actually allow you to still keep claiming those deductions even though you're not earning income. As I said before though, you have to meet certain criteria. So you have to be able to prove that you genuinely can't afford to pay off the loan, for instance, and it is quite specific again. So if this does sound like you, then I do suggest getting in touch and reaching out to your accountant as well. And just finally with penalty interest. So the most common example of penalty interest is what you might have seen before. If you refinance or pay off your loan early, you might incur a bit of a penalty interest, not just your standard monthly interest fee. So for a loan relating to a rental property, say you refinance and get a lower rate, which if you haven't done for a number of years, I do highly suggest you do that as soon as possible with the interest rates being so low. But you may incur some penalty interest. Even though a rental property is considered a capital asset, the ATO in this instance will usually say that it's deductible right away, so on revenue account. However, if that refinancing or penalty interest relates to acquiring the rental property or disposing of it, then that would be on capital account, so forming part of most likely your cost base, for instance. Great. The next topic we have is travel deductions. So previously, which was a nice little deduction a lot of people got away with, but if you used to travel to your rental property, you used to be able to claim travel deductions for that. Again, the ATO implemented quite big changes since 1 July 2017. So it really doesn't matter when the travel takes place or what you're doing around your rental property, you're no longer allowed to claim basically any deductions for travelling. So even immediate deductions or applying them against your cost base, it's basically just a straight up no. So typical situations, if we move on to the next slide, so this would be travelling to inspect the property, undertaking repairs and maintenance, collecting rent, attending body corporate meetings and so on. Even though they are related to you earning income from your investment property, you're just not allowed to claim any deductions for travelling anymore. In saying that, if we move on to the next slide again, there is a few exceptions. So the restrictions don't apply to if you're in one of these entities, so hold a residential property in these entities. They can be very specific again, and this one can be a bit of a grey area. So I do suggest contacting us, or again reaching out to your accountant, just to make sure that these exceptions do apply to you, because in most cases they won't, and you don't want to be caught claiming a deduction when you're not actually entitled to it. And the next lot of exceptions, same thing, quite specific, but for example, if you have to pay your real estate agent for their travelling fees, well, that's allowed because you're paying a real estate agent fee. You're not paying the travel deductions that you've incurred. That's really it around the travelling deductions. I might pass this back over now to Shannon, and she can run through the rest of the content with you. Thank you.
Thanks, Erin. So just to touch on depreciation and capital works deduction. So you heard Erin talk about earlier about those repairs that you couldn't claim as repairs, and you can claim them for capital purposes. So I'm just going to go through, because there's been some significant changes in relation to depreciation that I think a lot of people aren't aware of when they go running out to buy that investment property, and then they realise that they didn't get what they thought would be the negative gearing that they were hoping for. Now, I'm just going to start by saying what I want to talk about now is more the depreciation side. Capital works, and I'll touch on what capital works deductions are, because I'm not saying that there's no depreciation deductions at all when it comes to your investment property. Many of you will go and get a depreciation report done by a quantity surveyor, but that is two parts to that report. One is the capital works, one is what we call depreciation expenses, which are capital allowances. So capital works are those that are basically fixed to the property. And so, building renovations, extensions, so you add an extra room onto the investment property, any building alterations, structural improvements. So it's really part of the overall building. And capital works are the ones that, many of you might be familiar with it. It's like 2.5% deduction over the period, and it's a really sizable deduction. We all like the capital works deduction from that perspective. What I'm going to talk about now is on the depreciation expenses, but it's the capital allowances part. Now, the capital allowances refers to plant and equipment, the assets that are basically generally standalone, or kind of assets that serve a purpose. They're not necessarily fixed to the rental property, although they may be attached to the rental property, but they're not absolute permanent structures. Things like curtains, carpet, etc., like that. So just to be really clear, capital works deductions, no changes from what many of you would have heard. 2.5%, really nice big deduction. We all get excited about that for negative gearing. I'm going to just talk now about the depreciation and capital allowances. I know that there'll probably be a few people that will be reaching out after this to make sure. So when we're talking depreciation deductions, there were some new rules that came in after 9th of May 2017, an odd day, you might want to say, being 9th of May. That came in as part of the budget. So there may have been some of you a number of years ago in 2017 a bit nervous when there was a push about getting rid of negative gearing. Negative gearing, to give some history behind that, what the government did many years ago, get rid of negative gearing. They put it back into place just a few years later. Now, I look at negative gearing. It's great from a tax outcome for us, obviously, and many of you may have already heard me say there's no point in getting negative gearing if you're not getting capital growth, because then in my mind, that's just social housing. So we always want properties that are going to give us good capital growth. So buying in that great area that's going to continue to grow. Think of the peninsula, great capital growth, but other locations, and buying that kind of unique property or something that's going to get capital growth. The government was, one of the government was trying to push to get rid of negative gearing. This kind of came in as a kind of, I think, somewhat a political mechanism on controlling what was the property market inflating a lot, with a lot of investors and first time buyers not coming in. So it's a lot. What came through was that as part of the budget, they turned around and said they were going to restrict depreciation deductions. So from 9th of May 2017, or if you acquired in the 2017 year or earlier year and no depreciation deductions have already been claimed. So there's going to be these restrictions on these assets going forward. And this is a huge problem or issue that's happened with the investment properties, because it's really taken some properties that you may have in the past got a great negative gearing deduction for to not having that depreciation deduction, which we know is that nice big deduction that's got no cash outflow at this particular point in time. So no depreciation is now allowed if the asset, and this is after 9th of May 2017, no depreciation deduction is allowed if the asset has previously been used by another taxpayer, meaning it's secondhand. So if you buy a house that has curtains in it and the kitchen and all of the carpet, you can't depreciate the curtains, the carpet, anything that was already there, you can't depreciate that. It's considered secondhand. It was used by another taxpayer. Whether they claimed or not, it was used by another taxpayer. The only reason they've got that exception on the trading stock is if you buy from a developer, because they call it trading stock when they're actually building property. So that's the only reason there's that little exception. If the asset has previously been used by the taxpayer, so by yourself in your residence doesn't have to be your main residence. So if you had a holiday home that you always use yourself, and now you've decided we're going to rent it out, no depreciation on any of the capital allowance, but nothing on the plant and equipment. Yes, you can still look at the overall capital works, but nothing on the plant and equipment. And then the last one, if the asset has been previously used by the taxpayer for a non-taxable purpose, unless only occasional. So they're really restricting this ability in being able to claim a deduction for those assets. So where do we see some of these problem areas coming out? And I do see a lot of problems with accountants not knowing these rules, because we take on new clients to discover the accountant has been still doing it under the old rules. So it is a bit of a problem, because the ATO is looking at it and really focusing. It's easy money for them. It really is easy money. So the client problem areas we're seeing, the client buys an existing property after 9th of May 2017, and depreciating assets are purchased with the property. So, down in Mornington, they buy a house in Mornington, and the depreciation assets are purchased with the property. No depreciation. Client bought the property in a prior year, but it wasn't used for income producing purposes at all in 2017. And now, we've got that situation going forward. So I'm going to give you a bit of sorry, just quickly, did I skip on that one? Yeah, bit of example. I thought I skipped over the example. So let's just use an example. Greg purchased a rental property in July 2017. We'll just say Mornington, around the corner from us. Property was 12 years old at the time, so still a lot of life in a lot of those assets that are in there. The purchase price was $700,000. That's probably 1.7 now. Greg determines that the depreciating assets acquired with the property were worth about $30,000. So he's gone around and he thought the curtains, the carpet, etc. Can he claim a depreciation deduction for these assets? Unfortunately, the answer is no. They are considered, I guess you could say, secondhand. And the way the ATO is looking at it is they don't want people to be what they call doubling up on depreciation. So the people before may have had it as an investment property and depreciated it, but also the value of those depreciating assets form kind of the base, a part of the purchase price of the $700,000. So there is actually no deduction. And we look at it in two stages. One is, step one, we look, was the asset purchased with the property and after July 17? Yes, that's correct. So we already have that problem. And then we also look at how it was used. Well, in this case, because we already had the problem at step one, step two onto how the asset was used isn't relevant. If Greg had purchased in July 2016, no issue. We would have depreciated the $30,000. $30,000, no problem for that. So it's really about this timing. So where we're seeing some of the problem areas is that you have a rental property, move into it, use it as their main residence for a period of time, and then starts using it to rent again. No depreciation. Client inherits a rental property through a deceased estate post July 2017. No depreciation. You acquire a new assets for a property that will soon be rented out. Because if you had actually acquired the asset the day the property was going to be rented out, or you had listed it with the agent and the agent said, I need you to buy a new fridge for this property. And so it's openly listed for rent. And then you went and bought the fridge and put the fridge in the property. That would be depreciable. But if you actually were just getting the assets all ready for it, we've got restrictions on some of those. So there are some exceptions, but they're taking it as being that, and especially even if it was your main residence and you're trying to put in a few new assets before you then rent it out to someone else, then none of those are depreciable. What? Because you've actually been in the building because it was actually used, for your own purposes. So if I use an example, for example, Jenny's been living in a property as her main residence, but decides to move out in September 2019 and rent the property out. Before moving out, she buys a brand new fridge that will be used in the rental property. So can she claim a deduction? Actually, no. If she buys it, as I said, when she lists it with the agent and she's moved out, then she can. But if she is still living in the property, she cannot claim a depreciation deduction for that fridge. So it's really become quite strict in the way in which they're doing these deductions and allowing the depreciation or not allowing. It's similar to what Erin had spoke before. And a lot of these rules came out at the same time to really restrict the amount of deductions that people had on their investment property. Again, it was, there was a proposal to get rid of negative gearing. I don't know, and just from my Board of Tax position and hearing a lot of, we dealt with a lot of this before the budget was released in that year, and looking, Treasury had asked us to do some analysis on if they got rid of negative gearing. And I guess our view on it is negative gearing somewhat is a little bit of form of social housing because it enables there to be more rental stock. I know many investors that we have as clients, if they weren't getting negative gearing benefits, they probably wouldn't keep entertaining the idea of negative gearing. So it does enable a lot more rental stock. So some of the where these restrictions don't apply, the same as what Erin had talked before, in a company, we would probably never recommend you buy a property in a company. Super funds, except for SMSFs, it's not applicable, but just some of the different ways in which to structure. I don't see many of our clients being eligible to apply any of those. And then the only other restrictions are if the taxpayer is carrying out a rental property, like a business that rents rental properties out. So you're really running a business, and then it's able to be deducted. And then I guess one of the restrictions, as I mentioned, on the capital works. The other one is off the plan purchases. So one of the things, instead of restricting negative gearing, they've reduced the amount that you can deduct. However, I guess when the government did this, they didn't want to completely cripple all property developments, you could nearly say, and a lot of the developments come out in the off the purchase properties. So those that are off the plan purchases, those ones don't have these depreciation. So what you're really seeing now is, when I'm working with clients and they're looking at buying a property, the off the plan, if you're doing it from a strategic perspective on where you want to go, and again, you still want capital, you want capital growth. There is no point. That's why you've got to be very, very particular with your off the plan and what you're looking at buying, but you still want capital growth. If I'm doing a costing on if they purchased a property off the plan versus an already existing building, the negative gearing is significantly different because of the depreciation deductions that we're able to claim. And that may actually impact their decision-making process because there are some of the off the plans that we see that can be cash flow neutral after the tax benefits because of the depreciation deduction. So if you are looking at the different alternatives and you have some examples, we can always go through some of those with you. But this was really, I want to say it was like a halfway point of the government saying, we're not going to get rid of, one party wanted to get rid of negative gearing. We're not going to get rid of it, but we're going to reduce the amount that you can claim, hoping to take at that point, and it clearly hasn't worked post-COVID either, has it? But to take some heat off the market in that getting the owner occupiers getting into the market. So when can an investor claim depreciation deductions? So the asset needs to be installed and supplied to a new residential premises to the investor. So that's your off the plan type of thing. Or it could be a brand new house that you've built. Then that's all possible. That no entity has previously been entitled to claim a deduction for the decline in the value of the asset. So no person, no entity has ever claimed it. So basically no secondhand houses, so to speak, you can claim it. And also that no one's resided in it before it was held by the investor. So, that means your secondhand one, but that's also counting yourself as well. So if you are buying off the plan, as long as they do it within the first 6 months, that they've got that leeway there. So it is important to know when you can claim those, and that's why I'm always saying to clients, if you are looking at buying an investment property and you really want to know the after-tax cash consequence for you, and also the deduction, and cash is important on it, because there's many that still assume that they can claim quite a significant deduction for that, and that may actually change your decision-making process, because negative gearing reduces your taxable income, which reduces your tax that you have to pay. And if you've already paid it, maybe you're an employee, you've already paid that tax, you'll be getting a nice refund. So that may have a decision-making impact on that one. So new residential premises, you can still claim if it's acquired as a new property. It doesn't have to be an apartment, but it can still be claimed, and no one else has claimed it. So that, I just wanted to put that out as a separate slide to make that part very clear, because there was a lot of people that kind of thought, well, maybe I can't claim depreciation at all. The other one I wanted to touch on, I don't think it's going to be relevant for too many people, but there were a number of people who tried to argue that I'm running a rental business during the JobKeeper period, because they wanted to try and get the JobKeeper. Now, to rental property business, what we're looking at there is it's that tipping point of when your activity or what you're undertaking goes from being a passive investment, you're just renting out a property, getting the rent. You may be actively doing a few things, but you're collecting the rent, versus it's an active business activity. And what is that tipping point of when it becomes an actual business of investing? Now, the ATO has actually even gone through, and some cases have come through, that even someone owning 10, 15 properties does not mean they're running a business, a rental property business. They were still running passive investment. So if you do have some of the those types of aspects, happy to go through with those. If you are running on a business, a lot of those, exclusions we talked about earlier, all of a sudden are gone, and those would have been eligible for JobKeeper. So we did have a number of people that owned properties that were trying to argue the fact that they were running a business, unfortunately, during the JobKeeper time, and we did get some ATO guidance on that to make sure, but it is still a challenge and something that they are focusing on. So, and some of the factors, I guess, that they're looking at is the size and scale of the activities, number of properties, how many hours you spent. So even if you had 15 properties and you used an agent to manage them all, you're not running a business. If you had 15 properties and you were personally collecting the rent and getting all the repairs done and doing all of that, that would be more likely to be a business. So how much involvement in it. So something to think about if you are starting to build your property empire, and whether it's actually going to a business, kind of more as a business, that does give you a lot more of the deductions as well. So those are some of the key areas that we've seen that have been issues on the rental properties areas. There are obviously other deductions in relation to your rental properties, but these are the key ones that we get a lot of questions on, but that we're also seeing a lot of challenges coming through from the ATO as well. If you haven't already, today we'll put our recording up onto our website, which will be on our YouTube. We've got heaps of different sessions that we've kind of covered. So if there's any topics you want us to cover, feel free to let us know. That's usually what inspires us to come up with the different topics to be able to kind of help, and means you can have a look at it at a time more suitable for you. And just for those new people on the webinar today, our leadership team, myself, we also have Paul Cunningham, who is an associate, and Daniel McCulloch. So we're happy to work with you and assist you with some of your challenges. I just thought I'd open it up to questions. I haven't seen actually any questions come through, so maybe we covered a lot of the details or points that people had. Do we have any other questions? If you want to put that into the Q&A section, we can always address those and see if there's any questions coming through. No, did we answer everyone's questions? No, we don't have any questions. So that would nearly be a first. So maybe we just did a great job of covering it all, Erin. If you do have anything or something pops up later after today's webinar and you will get a copy of the notes, please feel free to reach out. And again, if you have any other ideas on topics that you think we should be covering, do let me know, because sometimes I get a bit not knowing what the next topic is, and trying to also know whether people don't love accounting as much as we love it. So I could talk about lots of topics, but wanting to get to topics that you would actually want to hear about. So if you do have any other topics, especially in the property space, I am trying to cover a lot more in the property development, subdivision, property investment. So if there's any topics that you want to suggest, please feel free to reach out. But otherwise, have a great Easter, everyone, and we'll catch up with you soon. Thank you.
Thanks, everyone.